For over a decade, borrowing money in Britain felt almost free. But to fight inflation, the Bank of England pushed base rates to a 15-year high, abruptly ending the era of cheap money. This has created a massive payment shock. Every year, roughly 1.5 million UK households come off fixed deals. Many locked in their mortgages between 1.5 and 2.5% and are now staring down refix offers between 4 and 6%. To understand the mathematical penalty, let's look at a typical £250,000 mortgage. Moving from a 2% rate to a 5% rate adds about £380 to your monthly payment. That is £4,560 a year, wiped straight from your take-home pay. Beyond the higher payment, homeowners face an algorithmic wall banks use to decide who is allowed to borrow. Even though the central bank's specific affordability rule was scrapped in 2022, strict regulations from the Financial Conduct Authority still apply. Every UK lender must stress test applicants before approving a loan. They run your application through a specific hypothetical scenario. The core question they ask is, what happens if rates jump another 1 to 3%? Can this household still afford the payments without going under? If their model says no, your application is declined or the total loan size is reduced. You are then effectively trapped on your current lender's standard variable rate, which is almost always the most expensive option on the market. When banks look at your affordability, the math is brutal. Lenders take your post-tax income and immediately strip away all your committed monthly outgoings. What is left over is your net disposable income, and that exact number has to safely cover the mortgage at their higher stressed rate. Because of how these models multiply your costs over the lifetime of a loan, micro-leaks have a disproportionate impact. Just £30 a month on a dormant subscription slashes borrowing capacity by £6,000. Actively plug those leaks. 3 months before applying, review your bank statements and ruthlessly cancel dormant subscriptions. Passing this part of the test depends less on the size of your salary and more on how you defend your net disposable income from automated spending. The second pillar is your credit profile. Lenders do not demand a flawless, perfect numerical score. What they are actually looking for is a predictable pattern of financial behavior. A harmless, isolated missed mobile phone bill from 18 months ago will not sink your application. But 3 missed direct debits in the last 6 months shows a recent pattern of stress, and that will trigger an automatic rejection. And to debunk a very common myth, checking your own credit file across the main UK agencies is a soft search. It does absolutely no damage to your credit score, so there is no reason to avoid auditing yourself. Your credit file is treated as a behavioral risk profile. Recent consistency vastly outweighs historical perfection. The third pillar is loan-to-value, or LTV. This is the ratio of your mortgage balance to your property's total value, and lenders group these ratios into strict percentage brackets, typically at 90, 85, 80, and 75%. This diagram illustrates how crossing a single threshold forces lenders to offer you cheaper interest rates. Drop from 82% down to 79%, and you cross the 80% line, knocking 0.3% off your rate. Making a small tactical overpayment to bridge this gap drops your interest rate, often paying for itself within 1 year. Deploying spare cash to cross an LTV boundary is often the highest return, lowest risk financial maneuver a homeowner can make. Sometimes the numbers genuinely do not work. If you find yourself failing the stress test, the worst thing you can do is simply miss a payment. Triggering an official arrears mark stays on your credit for 6 years and destroys any leverage you have with the bank. Instead, you can use a term extension as a temporary bridge. Stretching your mortgage term from 20 years out to 30 years artificially lowers your required monthly payment, making it much easier to pass the affordability check. You can also use the product transfer loophole. By choosing a new deal with your existing lender, you are often allowed to bypass the full stress test entirely, simply because you are an existing customer they want to keep. Communicating early with your lender makes these strategic options available. Silence, on the other hand, triggers automated penalties. The absolute best defense against future rate shocks is the 2% payment buffer. Calculate what your mortgage would cost if your rate was 2% higher, and save the exact difference every single month. This habit serves 2 purposes. First, it builds a cash emergency fund. Second, it forces your household budget to adapt to the reality of the shock long before the higher rate actually hits. Stop guessing about your own financial position. Run your numbers using the Cost Saver Mortgage Stress Test app to calculate your rate rise affordability before a bank underwriter does. Surviving the upcoming mortgage cliff requires methodical, algorithmic preparation rather than a high income or good luck.